Is this investment account better than the 401k or Roth IRA? Step 6 of my FIRE checklist is to max out my Roth IRA and HSA. Most people have heard of a Roth IRA, but unless you're in the FIRE community or just a super nerd in the financial industry, you probably haven't really heard of an HSA. And only 7% of Americans actually invest in this triple tax advantage investment account. An HSA or health savings account is going to become one of our sources of income with over $1 million invested tax-free to achieve financial independence and retire early. And believe it or not, 2022 was actually my first year investing in an HSA because I wasn't eligible to have an HSA with the previous company I worked for between 2016 and 2021. So in this video, I want to show you my progress with HSA and how I plan to use it as an extra source of income during my early retirement. So I want to show you my HSA projection here, and you can download this spreadsheet and my other financial independence resources for free by visiting firesearcher.com/contact. As of right now, with 2022 coming to an end, my wife and I will contribute a total of $7,300 to our HSA, and we treat this just like the Roth IRA or our retirement account because of the triple tax advantages it carries, and I'm going to explain that in a little bit. I'm going to add a 3% increase to contribution every year with a 10% average annual return. But so far this year, I'm looking at a positive 1% return because I didn't start investing in the HSA until August. So it could have been a lot worse if I had started investing in January. Then I would have been down about 16 or 17% year to date. Optum Bank also has a rule that I have to keep at least $2,000 cash and the rest into an investment. So it took me until August to reach the $2,000 threshold because I was contributing about $157 every 2 weeks with the employer match. But anyway, by the time I reach my early retirement age of 45, we should have about $145,000 invested in the HSA. And if we don't make any withdrawals and leave it where it is, we'll have $230,000 at age 50, $600,000 at age 60, and then $980,000 at age 65. And I'm also going to explain why age 65 is highlighted later on in this video. And we can also continue to invest in our HSA after we leave our employers and retire early because there are no income limits like the Roth IRA. With the traditional or Roth IRA, you need to have some sort of active income, not the HSA. We just have to have a compatible health plan, or also known as a high deductible health plan or HDHP. We know how expensive healthcare is in the US, and we all know it's only going to get even more expensive with inflation. So if we continue to invest until we turn 60 years old, we could have over $1 million invested in our HSA. And we're most likely going to need this as we get older and our health deteriorates. Now, you're probably wondering how in the world HSA works and why doesn't anybody know about this? Now, a lot of people get confused about the differences between FSA and HSA, and you can watch this video to understand the differences linked in the description below. But HSA is triple tax advantaged, meaning that I can contribute to my HSA in pre-tax dollars, grow my investments inside my HSA tax-free, and withdraw my HSA tax-free as long as I use it for healthcare, dental, or vision expenses. So what happens if I use HSA for non-medical expenses? The penalty is actually harsher than IRA or 401k with a 20% penalty instead of a 10%, plus state and federal income taxes on top of that. When you turn 65 years old, you can use your HSA for non-medical expenses penalty-free, but you'll still be responsible for the ordinary income tax. So at age 65, the $1.6 million we have in our HSA can become another source of retirement income and only pay federal or state income tax. Okay, so why are people in the FIRE community using this if it's only for medical expenses? Well, there's actually a loophole that I want to tell you about. The cool trick is that you don't have to take distributions from your HSA until much later in life. The key here is not to touch your HSA now and use your cash to pay your deductibles, copays, and other qualified expenses. For example, let's say I had to go to a clinic for a routine checkup that cost me $100 in copay. Instead of using my HSA to make the copayment, I'm going to use my cash to pay that $100. What I'm also gonna do is keep that co-payment receipt in the amount of $100, scan it, and store it on the cloud. I personally track it on my spreadsheet and keep both physical and digital receipts. 9 years later, in 2031, let's say I want to use $100 to take my wife out to dinner, then I can reimburse myself for that co-payment that happened in the year 2022, because I can reimburse myself whenever I want in my lifetime, as long as I have the receipts to prove to the IRS that I paid a medical expense out of pocket. Because we're gonna have tens of thousands of dollars in out-of-pocket medical expenses, we're gonna reimburse ourselves with the HSA to treat it like an extra source of income during our early retirement. How awesome is that? And let me show you this general diagram of how HSA works to make it easy for you to understand. I'm a W-2 employee and my company offers HDHP, which is a high deductible health plan, right? In 2023, I'll have my employer deduct $7,750 or almost $280 every 2 weeks in pre-tax dollars to go into my HSA. The $280 I put into my HSA every paycheck is not taxed whatsoever by federal, state, or FICA. If I'm unemployed or self-employed, I can still contribute to the HSA as long as I have the HDHP. Makes sense so far, right? Also keep in mind that some employers will contribute to or match your HSA. So if your employer contributes $1,000, then you need to account for that to your total contribution limit for that tax year. And when I started contributing to my HSA in 2022, and this will depend on the broker or banker that you have, I had to wait until my account balance reached $2,000 to start investing with Optum Bank. And when I reached $2,000 in August of 2022, I had an automatic transfer set up between my HSA and my HSA investment account. The only mutual fund I invest in is the S&P 500 index fund, ticker symbol VFIAX. And please keep in mind that this is not in any form of financial advice, but it was really easy for me to set up automatic investment transfers. And as you can see in this screenshot, the minimum threshold requirement is $2,000. So whatever is above that amount will be transferred automatically to the S&P 500 index fund. And all of its capital gains and dividends are tax-free. And if you don't know what S&P 500 is, I encourage you to check out this video linked in the description below. But my portion is gonna be $3,650 with my employer, and my wife has her own HSA also at $3,650 with her employer. My screenshot is only showing $3,000 at the time of recording this video because we're both qualified HSA individuals. So while all that investing is happening in my HSA, I use a separate savings account to pay for any medical expenses. For example, let's say anytime we go to Costco pharmacy, CVS, or Walgreens, we keep a copy of the receipt physically and digitally. And I also create a spreadsheet to keep track of our out-of-pocket medical expenses. And to keep things organized, we put 4-digit year, 2-digit month, 2-digit days, and the pharmacy name. And we've spent almost $4,500 out of pocket just in medical, dental, and vision expenses so far this year under our HDHP. So later on, when we're retired in the year 2031, we can actually reimburse ourselves the $4,500 that we spent in the year 2022. And if you're still not sure how to hack your HSA for your FIRE movement and you need help with your personal finances like budget, savings, and investments to achieve your financial independence, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesession.com/coaching. So if I had to pick to contribute between my HSA and Roth IRA, I'm gonna pick HSA first because of the triple tax advantages. Step 6 of my FIRE checklist is to max out both HSA and IRA. We're contributing $7,750 to our HSA and $13,000 total in our Roth IRAs between my wife and me in the year 2023. And let me show you the eligibility requirements to open an HSA. And if you and your spouse are both actively employed, you can each have your own HSA up to the federal limit. However, if spouse 1 doesn't have HDHP and spouse 2's healthcare is covered under spouse 1, then you're not eligible to contribute to an HSA. But if spouse 1 is covered under HDHP and not on spouse 2's non-HDHP, then spouse 1 can contribute up to the individual's federal limit, while spouse 2 doesn't contribute to an HSA. Easy peasy, right? If you want the maximum family contribution limit, then you both need to be covered under HDHP. And what are the qualified medical expenses under HSA? Let me show you this chart, and I'll link it in the description below because it is too much for me to read in this video. And what most people forget is that over-the-counter medicines like aspirin or Advil or something like that, or even eye drops, are also qualified medical expenses. So if you're gonna be a die-hard HSA investor, I would keep all of the medical expenses on separate transactions so you can store those receipts for reimbursements in the future. And what is a high deductible health plan, or HDHP? The monthly premium is usually lower, but you end up paying more in healthcare costs yourself before your insurance company starts to pay its share, which is your deductible. It's a high deductible plan combined with an HSA that the IRS allows you to pay for medical expenses tax-free. For 2023, the minimum deductibles for HDHPs are $1,500 for individuals and $3,000 for families. Your maximum out-of-pocket will be $7,500 for individuals and $15,000 for families. The maximum HSA contribution limits are $3,850 for individuals and $7,750 for families. So you get an extra $50 if you're in the family plan. But what makes you ineligible for an HSA? If you change your health plan from an HDHP to a non-HDHP, or if you contribute to a healthcare FSA, however, you can't contribute to the limited healthcare FSA, and you can watch this video about the FSA versus HSA linked in the description below. If you're enrolled in Medicare, whether it's age-based, disability-based, or disease-based, if you're claimed as a dependent on someone else's tax return from the previous tax year, if you're covered under your spouse's non-HDHP, as I talked about earlier, if you receive health benefits under TRICARE, if you receive medical benefits from the VA or Veterans Administration for any non-service connected disabilities at any time during the previous 3 months. And if you want to know more about how to invest in your Roth IRA and HSA, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.